long term, I'm very, very bullish on Ethereum. Um, but I would say.
All right, welcome everybody. Today I'm sitting in for Rahul Pal. So if you were expecting a tall Brit with a British accent sitting here, then I'm sorry to disappoint you. I'd probably butcher that up even if I tried, given that I'm based in the southernmost part of Germany in Bavaria, so the British accent doesn't come easy. But I'm happy to do it. My name is Moritz Seibert. I'm the Chief Investment Officer of Exponential Age, and it is my great pleasure to welcome you, Joey, a repeat guest, I think, to the show. Joey, you are the co-CIO of Pantera Capital. How are you doing?
Doing well. Yeah, thanks for having me.
Yeah, so how are the markets treating you? I mean, what a quarter has it been, right? With, Luna and Celsius and three arrows and, Ethereum below 1,000 and not right now as we do the recording on a Tuesday, but I guess, a week or so ago we were in the even below 800 if I remember correctly, and, Bitcoin below 20K. So, how are you guys faring?
Yeah, I mean it's definitely like the most challenging environment I've seen from a price action standpoint in crypto. I started investing in Bitcoin back in 2011. Obviously, the drawdown in 2011, 2012 was worse than this in percentage terms. But in terms of like total capital and kind of the scale, this is like much more intense than that. At least for me. One thing that's interesting about it is how fast it's happened. Like in the 2018 drawdown, it really kind of just like slowly, steadily bled out over a year. And then the market kind of bottomed in December versus here, crypto is tracking equities at like, 2.5 to 3 beta sort of. And then we had this Celsius stuff with the 3 arrow stuff kind of blow up all at the same time. Obviously the spread versus equities got really blown out, and you saw, ETH trading in the low 800s, Bitcoin 17K, that sort of thing. So it's been a really interesting and definitely challenging environment.
Yeah, I find it interesting that you say it's, happening so fast. I mean, in November of last year when we launched the fund, obviously at the high of the market, as you casually do when you launch a hedge fund. But that was kind of like the high of the market, right? Which is, what is it, like 9 months ago or something like that. So over the last 9 months, we've been moving lower and lower and lower. But what I'm kind of missing, it feels like a little bit of a slow motion type of move. Like every month is down a little bit. What we haven't seen yet is this extremely violent, like red candle that flushes everybody out. That is extremely painful. Another massive deleveraging to the extent that's still possible. I'm not looking at the data there, and I don't have the data. I'm not sure to what extent the market has already deleveraged, but I'm not saying that it's required, but in my experience, looking at markets for more than 20 years, you've always kind of like had this, like this last push, like here's another minus 10% day in the Nasdaq, or another minus 20% day in Bitcoin, and then everybody just gives up and cries uncle.
Yeah, I mean, I've been hoping for that too, because when you have that, it's like a clear bottom signal, right? Like, you have this kind of mass capitulation. You feel like the sky's falling, and like that's probably the day the market bottoms. The thing that I was looking at, which makes me think that may not happen this time. Like it may just be, we may have either already bottomed, or there's just going to continue to bleed out a bit more, and we'll reach a bottom at some point. Is if you look at the futures markets data, so the perpetual futures and the regular futures, and you look at open interest, when Bitcoin went from like 25K to like 17K, obviously there were liquidations, but like it wasn't that much. It wasn't like you had these like big liquidation cascades that you would have had in the old days. I mean, we even had a liquidation cascade like that back in, I think, December of last year, where ETH fell, I think, $1,000 overnight, and then it bounced back up the following morning. And my theory on it is, I think what's happened is the market's evolved into a regime where that leverage and risk exists, but it's not on the futures exchanges. Like it exists in these kind of like dark pools of capital where there's these lenders, and people are taking leverage via loans, and you can't really track that. And the liquidations are less like one candle capitulations, because it's not an exchange that's like liquidating it all. It's like often people who have discretion, who try to like tee up their orders, and I think that's my thesis for like why we've seen this like steady kind of just like bleed out in terms of price action.
Yeah, and we've seen a couple of things now. I was just saying what a quarter it has been, with Luna and Celsius and 3 hours all happening within, a 3 months type of time frame. But what I found so interesting is, speaking to my friends, I was saying, look, I mean, most of the attacks and most of the exploits these days happen in DeFi, like, some bridge or whatever gets exploited, and that's where the hack happens. And it's been kind of a while since we've had the last attack on a centralized exchange. The in the old days it was exactly the opposite, right? I mean, the exchanges got hacked, and coins and tokens were removed there. But now it's the opposite. And then by the same token, well, bad saying, I guess, but you know, um, right now DeFi is super stable, and the centralized places, such as Celsius, but there's also others. That's where all the problems happen.
In DeFi, you have like two sides of the market, right? You have like the really cutting edge stuff that's like very experimental. It's never been done before. That's where you see like hacks happen. And if I were like a retail investor, right, like I would just like steer clear of that stuff, until it's ironed out, or like don't put in more than you had to lose, sort of thing. Um, and then there's this other part of DeFi which is like pretty stable, right? Like you alluded to it, like you have like MakerDAO, Compound, Aave, these lending protocols that they've been around, in crypto terms a while, and traditional finance terms, not that long. But they've been pretty robust, and they've seen a lot in terms of market movement. If you look at MakerDAO, it survived the March 2020, huge red candle where crypto went down like almost 50% in one day. It's also survived this current kind of like set of cascading liquidations. And I think the reason is DeFi is like, it cares less about who you are. So like there's like in traditional lending, right? Like if you're like Three Arrows or whatever, you can go to a lender, you can go to one of these big firms, and you can say, well, we're Three Arrows, right? Like, we have all these assets, like, and you can get like an uncollateralized loan, or you can get a loan by posting collateral that's relatively illiquid. Um, but in DeFi, the DeFi markets, they're just code. And so they say, no, like you need to post a good amount of collateral. It needs to be highly liquid collateral. And by the way, if it's 3 a.m. on Christmas Eve, we don't care. If you're starting to have a position that's close to becoming underwater, you're going to get liquidated. It's a bit harsher of a system, but it's also much more robust, especially if you're lending capital to someone. Like at this point, if I were lending capital, which I'm not, but if I were, I'd much rather do it on DeFi venues. Sure, the yield may be a bit lower, but your risk is I would say like an order of magnitude lower than via like a centralized black box.
Yeah, I mean, the code is rules based, obviously, and ruthless as well. So, like you say, 3 a.m. on a Christmas Eve, if you are, under collateralized, then that's your problem, and you got to fix it. Whereas, if you work on a centralized platform, it's not so clear. I mean, to be quite frank, I think some of the businesses that these platforms run, it's more like a kind of like a hedge fund put on a platform type of business. I mean, you can do a lending business in many different ways. Traditional lending, you would have maturity transformation and counterparty risk and fixed versus floating, all these type of things. That can be a very type of stable business, and some of that is it's in traditional finance. That's the classic lending business. A lot of these risks are hedgeable and transferable, which is why it's traded at rather thin margins. But here you have these new platforms, and they're essentially taking customer capital, and instead of segregating that capital, they're saying, look, I'm paying you 20%, I'm paying you 10%, whatever, right? But I'm not really telling you what I'm going to do with your money. I'll just do something. So the platform with I own all the upside. I pay you, an attractive notional yield, but you own all the downside. I think it's kind of like a hedge fund that is available to retail without any regulatory framework around it. That's what it looks like to me.
Yeah, it's a really weird structure. And that's basically what it is, right? Like I've obviously seen these companies from the diligence side at Pantera, and then obviously you can also just get a lot of this data by looking publicly. And a lot of them, or not a lot of them, but it's a good chunk of them put their capital into things like risky DeFi stuff, or like doing a bunch of trades on chain. Often like the collateral that you're posting, like if you say you give them Bitcoin, it may not stay in Bitcoin, right? Like they may take that Bitcoin, sell it for ETH, and then do some like YOLO DeFi bet. um, or they can do anything with it, right? Like the point is you don't know. Um, and the other thing is like as a retail user, you don't understand like say I give them $100 and then say a million other people give them $100 as well. For that $100 million pool of capital, how much time does it take for them to liquidate it? Like you don't have any idea what the average duration is on that capital. And often they're putting things in trades that are, duration defined. You've also obviously seen people put money into things like, betting on the GBTC discount returning to neutral or premium. That obviously has huge duration risk, and it may take years. It depends on what the SEC is going to do. And so, yeah, to sum it up, I think you're right. Like it's this weird structure where like because it's hard for retail investors to get access to hedge funds in the U.S. Instead, these companies have built this kind of like weird unregulated area where they're effectively doing that. But with a hedge fund, obviously you can lose all your money. But if you're lending to someone and they're paying you 10%, you can also still lose all your money. But if they 10x the capital, like you don't get that 10x. It's kind of a bad deal for the counterparty.
I agree with that. Actually, the GBTC discount deal, I've never traded that one, so I don't have that on, but I found that interesting to observe because, as you know, I used to trade at premium and you could do the ARB. And then, when something like this goes to like a 5% discount, then most people would say that is a massive discount, right? 5% is a lot. So you'd be buying, GBTC and you'd be selling spot and you'd be selling a future against it. But then that spread moved to what, like to minus 32? I mean, if you got on at -5 and you take it to minus 32, that is a massive loss. So these type of trades, they aren't as juicy or as appealing as most people think. But coming back to DeFi, I think most of DeFi, a lot of DeFi is down what, like 80%, 90% sometimes from the tops. And clearly I'd say not everything in DeFi is like, a Ponzi scheme. Like you've mentioned MakerDAO and, Sushi Swap and Uniswap, and, these protocols work. And I wouldn't see why, they're spitting off cash flows essentially, and, they're profitable. So I don't see any Ponzi scheme thing there. But you may have listened to the podcast with Sam Bankman-Fried on Outlaws on Bloomberg with, I think, Matt Levine and Tracy Alloway and Joe Weisenthal. And so Sam was saying it's the magic money box. DeFi is, some token goes into a box and, it never comes out of the box. So I was a little bit puzzled as to, why he was putting it that way. Maybe that's true for some parts of the space, but clearly not everything. What's your view there?
Yeah, it's an interesting point. I mean, I think like it's kind of like what I alluded to earlier, right? Like it's like two camps of DeFi. Like there's the stuff that's like actually pretty fundamental. It works. It's pretty robust. The problem with it is just that if you're trying to get a really high yield, you're not going to get that, right? Like you're not going to make 30% lending out on compound. But at the same time, your risk is much lower. There's the famous lines like there's no free lunch, all right? And I think like it's true in DeFi and it's true everywhere else. If you look at the stuff that Sam's referring to, there's a lot of new DeFi projects that like when they launch, they have some sort of incentive mechanism to try to get people to use it. And sometimes that works, and then you remove the incentives and people still use it a lot. Other times, it never takes off. There's no actual fundamental usage, and then it kind of blows up, right? Like you're providing these incentives, and the protocol doesn't get actual fundamental like organic traction, and then so the incentives eventually become worthless. But like with all of these trades, there's different ways to do them. Just like the GBTC one, if you buy GBTC and the discount goes from 30% to 40%, okay, you lost some money, but like it's not the end of the world. You can always sell your position at a loss. If you do the same trade, but you lever it up 3 times and you do it via, borrowing a bunch of capital and buying GBTC and storing spot, then you have a very different scenario, right? Like that trade has blow up risk. And I think these DeFi trades are the same. Like almost any of these trades, you can construct them in such a way that you don't have blow up risk or you have very low blow up risk, but it obviously reduces your returns. And so I think that's kind of the trade off. But if you look at Sam, like Alameda has done they participated in a lot of these trades like via their prop shop, basically trading in and out of these like DeFi, I like to use his terms, black boxes. But I'd say like for us, like that's not really our model. We're more investing kind of, I'd say, like on the earlier stage side of new projects, when they first come out, that sort of thing.
Yeah, no, absolutely. I mean, before we go into the earlier stage tokens that you've just mentioned, I'm not sure if you have any Ethereum on your book, but nevertheless, I'd like to speak to you about it. We have that merge upcoming. At least, that's what the market is expecting. I have the feeling. I mean, there's no, clear like date where, the Ethereum Foundation would say, oh, it's going to happen at the, last business day in August or anything like that. But, people say it's probably in the end of August, end of October type of period. Um, but so every time I speak to clients, every time I speak to friends, Ethereum comes up as kind of like the main position. Like, Bitcoin's here, but Ethereum is now here. Everybody wants to be super long Ethereum. So it gets me thinking into like, is how much groupthink is there going on? Because they're telling me they have the trade on, they have a long position on in expectation of the merge. And because the merge is going to be doing something miraculous and fabulous to the price and, Ether is going to, be making new highs immediately. And that's just, markets don't really work like that. When you have this big consensus trade in the market, I'm not saying it's, it needs to go the other way, but it could just sit there and have that fully priced in. So I'm not sure if this is, what type of feedback do you get? I mean, is that a trade that you're interested in, or would you say, no, I'm fading the news, and, I'm not really keen to, to play the merge as an event-driven trade?
I guess what I'd say is I'm long term, I'm very, very bullish on Ethereum. Um, and but I would say, like, to your point about consensus trades, like, sometimes you get like this trade though on Wall Street, like everyone's doing, right? Like a few years ago, I remember there was like this Argentinian bond trade that everyone was doing, and the trade blew up, and some people lost many, many hundreds of millions of dollars in it. And if you look at this trade, I mean, it has less blow up risk. Like it's not like the Argentinian bond market, but I think you can lose money on it, right? Like if you buy a ton of ETH, expecting that the merge is going to happen soon, that trade can go wrong a couple of ways, right? One is the merge can get delayed. And on this, like I remember Ethereum 1.0 is launched, and I remember like if you look at the way people announce stuff from a developer standpoint, when people say something's going to ship around X month, it never ships that month. When people finally, put like a deadline on it and say like it's going to ship like August 23rd or at whatever block height, whatever block number is the equivalent of August 23rd at midnight, then like it actually happens, right? And so far that hasn't happened yet for the merge. So my view is that like until we have that hard deadline, it's just going to continue to get delayed. And with the first version of Ethereum, there was actually this prediction market, I forget the name of it, that I bet on when it would launch. And I got very good odds on it because no one believed it would actually launch. But I was like, no, like this time they actually put a deadline, so it's actually going to ship at that date. And here, I think the merge may just continue to get delayed a bit. I do think it's going to ship relatively soon, but whether it's August or September, October, November, December, or January, is anybody's guess. So I think that's the first way it can go wrong. And the second way it can go wrong is just everyone's already bought, right? Like I've met a lot of people who, to your point, say like, I put on this trade because the merge is going to happen. I haven't met anyone who's been like, I'm waiting to put this trade on because the merge is going to happen. And so right now, actually, we're very heavy in Bitcoin relative to ETH. We don't do that very often, but I think this time, like it actually makes sense. And my view is that like there's going to be a ton of positive price action right around when the merge happens and after, and maybe even after we get like a final date that's announced. But I think until then, ETH BTC maybe just goes down or it just stays flat and kind of chops around here. Like I don't really see the bull case for why like ETH BTC could double on a relative basis pre-merge. The people who are believers have already bought, and the people who don't believe won't believe that it makes sense until they see it in practice. It's kind of my take on that trade.
Another way it could go wrong, and maybe that has a super small probability, is for there to be a glitch. I mean, it's the largest smart contract platform on earth, that runs all the time, and we've never had it kind of like a life experiment moving from proof of work to proof of stake. So I'm sure they've tested it many and many times, and but you just never know. I mean, this is software. Some stuff could go wrong. And then, lastly, I think, and this is just my perception, when I speak to people, a lot of people think that, oh, the merge is going to, create a better Ethereum, like, a faster, higher velocity, higher throughput, more cost efficient type of Ethereum. Long term, like you say, there are many reasons to be bullish on Ethereum because, with sharding and, other type of upgrades, it will become faster. But what we're doing with the merge is moving from proof of work to proof of stake. That is, I mean, there's some other things, but that's the big thing. So there's a risk of being disappointed if you're holding a long position that, oh, well, not that much has really changed. I mean, it's a little bit more ESG friendly, a little bit greener because, it doesn't, use all that electricity, but that's kind of it for the time being.
Yeah, I think like the hard fork after the merge, I forget what they call it. They used to call it like, phase 1.5 or something. I don't know. The naming scheme has changed so many times, but basically there's a hard fork that adds in a bunch of stuff that makes it really easy to do, like scalable layer 2 kind of roll up solutions. And like that, I think is actually a bigger event than the merge. It'll happen after the merge. I don't know how long after, but that's what actually enables all the scalability stuff that a lot of people associate with the merge. And I think it's just because people haven't followed it. Because if you roll back the clock 2 or 3 years ago, ETH 2.0, when it launched, was supposed to have like sharding and all this stuff. And now the scope has gotten narrowed, which I think is a smart thing to do from a software engineering standpoint. But to your point, I don't think all the public perception has quite like understood that. And so, yeah, I think an actually bigger event is what comes after the merge, where you enable this stuff that enables a lot more scalability.
I mean, let's try to look forward to that point after the merge when, let's say, sharding is in place and you really have a higher throughput, higher velocity, more efficient Ethereum blockchain. I mean, it is the largest smart contract platform today. It has the largest developer community, so why would it not? I mean, is there a case to be made that Ethereum could actually increase its moat around all the other smart contract platforms like Avalanche, Solana, Polkadot, all the other layer ones? I mean, how many programmable blockchains do you need? And what's the role of, say, Polkadot 3 years from today, if and when Ethereum really can do it all and it, has everybody behind it?
There's a few different trade-offs that you can make, when creating blockchains, and there's a few different ways it can play out. So one way it plays out is like, ETH2 is just this main base layer. All these other scalable chains like basically create layer 2s to bridge to Ethereum. And you might say, okay, well, why not just like build on Ethereum, itself, or build on a layer 2 on Ethereum? And there's some good reasons, right? Like if you look at Solana, to take that as an example, the architecture of it is really suitable to things that require really high throughput and really low cost, like video games. If you look at a lot of the gaming use cases, I could totally see them succeeding on Solana versus like Ethereum. It may always be 10 times more expensive and 10 times slower than say Solana, but that's perfectly fine for a financial use case, right? Like it doesn't matter to me if I'm doing $1 million trade, whether my trade costs a tenth of a penny or 1/100th of a penny. I mean, it might if I'm doing like some Forex thing, but for most use cases, the security, it being reliable and having 100% uptime matters much more. Versus for a game, if I have like 0.05% downtime and there's like 10 minutes, once a month or whatever frequency it is where my game's offline, like it's not great, but it's not the end of the world. And it's a trade-off that I would totally make as a game developer, because my users will pay such low fees that they won't even notice like that they're paying fees. So I think there's use cases like that where you see some value. The other area is like, if you look at Polkadot's model, it's sort of interesting in the sense that like their model is every large application is going to want their own basically blockchain that can interact with a main kind of layer 1. And you might say, okay, why would you want that? There's some interesting reasons, like, if you imagine an application that has like tens of millions of users someday, hopefully we get there. There's definitely like custom changes you would probably want to make to the chain itself versus just purely building straight on Ethereum or something like that. But I don't think you need like 10 layer 1s, right? Like there's these 2 to maybe 4 different types of trade-offs. And there's maybe 1 or 2 that I haven't, thought of, or that no one's even thought of yet. But I don't foresee there being like 10 or 20 or that sort of thing.
Yeah, neither do I. I use the analogy, maybe rightly or wrongly, it's kind of like, how many car brands do you need to have in the world? I mean, clearly there's probably, more than 50 or even more than that. I don't know. They all take you from A to B. The reason there are so many brands is because of, consumer preferences, and I like one model and you like another model, but it is something that is physical, that has a design that you can drive, that you can touch, that you can look at and enjoy. Whereas code, whether it's Solana or Polkadot, I mean, it's kind of difficult to fall in love with code unless you're maybe the weirdo computer scientist. But I would say it's easier to fall in love with a Porsche than it is to fall in love with a piece of code. So that's what I'm saying. Like there probably must be just a handful of programmable blockchains that will persist, and stuff will just run on those, and all the other ones need to give way.
It might be more like the operating system or databases, right? Like operating system wise, there's hundreds of stuff out there, but really there's basically three in practice. It's like OS 10, um, Windows, and Linux, right? And there's a handful of other things. Those are the main ones. And then if you look at like databases, you have like Oracle databases, you have SQL databases, and you have a few other main categories. And then sure, like if you look, there are hundreds of other types that have like, sub 5% market share, right? Like Oracle, SQL, NoSQL, and one or two others, they have like 95% share of the database market. And it's good enough for 95% of use cases, right? I think that's probably how the layer one landscape shakes out. There's always going to be some like, niche person who wants to run like Gen 2 Linux, and there's probably going to be a blockchain that like, is a similar kind of niche community. But, most people are going to run Windows, OS X or Linux, that sort of thing.
Hey, let's shift gears a little and talk about Tether, because Tether kind of like looms large. It's no longer as large as it used to be a couple of weeks/month ago. But this morning I picked up an article in the Wall Street Journal saying that the short Tether trade is, well, it never really stopped, but it's kind of like back, and it's bigger than it's ever been. And so the report went on to say that the short trade is actually on by traditional hedge funds. So it's not like digital asset hedge funds putting the short trade on, but traditional hedge funds putting that trade on, with digital asset hedge funds being the other side of that trade, and acting as a counterparty. So this is an interesting trade. It hasn't worked yet. I guess it'll. Well, I don't want to say. I think there's a higher chance for the trade to never work than for it to actually work. But obviously, it could be extremely asymmetric type of risk return payout. So, what's your view on that? I mean, and obviously, I guess if Tether breaks, and I don't think it can really go to zero, the dilution of the cash pool would probably stop at some point. But there's so much systemic interdependencies with Tether, because derivatives are priced in Tether. I mean, what actually happens when the numerator goes to zero? Does the denominator trade at infinity? So it's definitely going to be fireworks. So how do you view that space?
The way I would think about it, like quantitatively, is like, I bet a lot of money that Tether could pretty quickly fulfill. If everyone redeemed, they could probably fulfill 80 cents on the dollar very quickly. I would bet like very high confidence that on at least that, and I'd probably bet pretty low confidence that they could fulfill more than 97 cents very quickly, right? Like that's kind of my confidence band. And so I agree that I think it's very unlikely Tether like blows up in any meaningful way. And I think odds are it's probably much closer to the 97 than the 80, right? That's just like my confidence interval. If you forced me to bet against you, I would. Um, and I think from the hedge fund standpoint, though, I actually don't think it's a very good trade on either side, right? Because like neither side has actual like good information about it. And on the person who's providing the exposure to the traditional hedge funds, they're earning some like interest rate on an annualized basis. It's probably not that great of like a sharp return. Like if you adjust it for like the risk that Tether's at, say 90 cents on the dollar, which is like non-negligible. And then for the hedge fund, it's like not that great a return. And from the standpoint of you're paying a pretty hefty annualized interest rate, and the base case is actually that it stays at a dollar, right? Like I think like the odds that it just continues to trade, 99 cents to a dollar is very high.
Yeah, let's use your confidence interval that you just mentioned there, between 80 and say 97 cents, right? I mean, then obviously timing matters because let's just assume that it costs 10% to borrow Tether per year, right? Or let's say it costs 12% to do that. So we have like 1% per month. I mean, I'm not sure if that's the right number, but it's kind of like, I guess it's ballpark correct in the right zip code. So, if Tether goes to 97 from, $1, it goes to 97 cents, that's a difference of three. So it's kind of like, let's say that's 3%. Okay, fine. So you need to get the timing right within like a quarter, right? Because you're paying 1% a month. So if your timing's off just by a little bit, the asymmetry goes away. It can only come back if, Tether really goes from $1 to 80 cents, in which case you have a 20-cent profit. And if that happens within a quarter, you've paid 3% so you make a net 17. I mean, the math is kind of like, butchered up here a little bit, but the ballpark is right. So that is what I'm not really interested in that trade. I mean, the asymmetry would really be there if Tether were to go to zero, like Luna or Terra type of scenario. Then you don't have to worry about the timing so much. You can have the trade on for let's say a year or two, pay 12 to 24%, and you would still be exposed to a massively lopsided payout. But given the fact that let's say it's floored at 80, it's actually not a good trade. I mean, I wouldn't do it. And like you say, I also wouldn't take the other side because it is a non-zero probability that it actually does go there or slightly below 80, say. And it's so with the managers that we have money with, we're actually checking that, and we're not so keen on anybody having that trade on, to be honest.
You do have like convex risk that it goes far below 80 in like an edge case scenario where somehow capital controls get enacted surrounding Tether, right? Like say for some reason, like their addresses or stuff gets somehow they get put on like the OFAC list or something, right? Like then it goes way down. And that's a scenario where it's actually backed, right? But like the government just decides they hate it so much that they're going to, literally send it to zero. And like, yeah, it's probably only a couple percent chance risk that actually happens. Um, but on the hedge fund side, it's not enough to make your trade good. And on the lender side, like, you're earning like maybe 12%, 20% annualized, whatever it is. And there's 2% risk, like it literally blows up and you lose all your money. And so it's like a trade that's it's like a very like edgy trade, I guess. Like it's not like a convex trade. It's just like convex in the wrong direction, I guess.
I mean, I hope that, given that Tether is so large, so dominant in the space, that they're improving their collateral position, so they're becoming more cash-like and cash equivalent-like, and less commercial paper and less credit risk essentially in their book, and that they get regular audits, and then I guess you can have the trust. Look, I mean, it has been attacked before, so far. I mean, it's actually battle proven, right? I mean, they've survived those attacks and they've, made billions and billions of dollars in liquidations in a very short period of time. So that actually, I'd say, would make me confident that they're capable of doing that. So another reason why I'm not so keen on the trade. Anyway, I mean, Tether is always going to be there. I mean, the fact that you're interested in the early stage stuff, what do you see there? I mean, a lot of these things have come down. NFTs, I mean, I'm not sure what type of sector classifications you're using, Web3 and metaverse and gaming, and what excites you these days? What's on your radar screen, and what are you bullish on for the next 12 to 24 months?
Definitely very bullish on like layer twos. Arbitrum, Starkware, Optimism just launched their token. I think like the layer ones and layer twos are kind of converging to the same thing long run. So layer ones built these scalable blockchains, but the bridges between them were not secure. The layer twos built very scalable bridges between the layer one and the layer two, but their blockchains, they're 10 to 100x more scalable. They're not like 1,000x more scalable, right? And so both are going to try to solve the other end of that problem. And I think, long run, you end up with systems that are actually pretty similar. So I'm excited about layer twos. We're also very excited about, anything on the early stage token side, whether that's like DeFi stuff, gaming stuff, NFT stuff. I think it's just an area of the market where you didn't have as many traditional VCs investing. And so I think like valuations there are a bit more attractive versus the equity rounds haven't really come down in price enough yet for us to want to like aggressively deploy there. I mean, obviously we're still doing investments and stuff that we think like have really high upside and are really awesome founders. But I think like all else equal, if I had like, two teams that are exactly the same and I had a limited amount of capital, and I could only had enough capital bet one on one team, I'd pick the one that was an early stage token just on a relative basis from like a macro kind of portfolio allocation standpoint right now. So that's sort of what we're excited about, I would say.
Just out of interest, I mean, is there any token, maybe in your book or like any project that you can think of that actually managed to decouple from the bear market, crypto winter, whatever you want to call it? I mean, the move lower in 2022. I mean, is there anything that's up and in the greens?
There probably is. I don't know if there is, but I'm sure there's something out of the 20,000 assets in this space. But yeah, I'm not sure what asset it is.
Yeah. So probably not in your book. I mean, everybody I speak to, everybody's hurting. Everyone's portfolio is on fire, and all these coins and tokens are down. Nasdaq's down, and the dollar is up, and energy's up, and everybody's hurting. Yields are up. So, I mean, with that said, it kind of like it feels like at some point we're all due a little bit of a move to the top side, a move higher, and to get some of that pressure off, and it would help everyone. I mean, I'm not sure if we've seen the lows yet, to be quite honest. This is just my personal opinion. I wouldn't be incredibly surprised to see Bitcoin go below 15K, and to see ETH go below 1,000, or below 750, 700, something like that. Maybe that is the flush out then, and then we can move higher. So I don't think we're kind of like out of the risk zone, or we're having a smooth glide path to the upside from here. But let's see. What's your view?
Yeah, I think a lot of it depends on the macro environment, which is something that like I've been in crypto, I guess, 11 years now, and macro is never relevant, right? Like it didn't matter. Crypto was so small, and macro is also like a generally happy place for that 11-year period. But now it's become a huge part of it, and my view is I think a lot of like is the worst over, or is it going to get a lot worse? Depends on like what happens on the inflation side of things, right? Like you have a lot of people saying, oh, it's the 70s V2. And my personal view is I don't like the Fed's going to make that mistake again. They seem to be pretty aggressive about hiking, but so there's like that question mark. And then one other element I think is if you look at like valuations, they have come down a lot, like even on the public equity side in terms of earnings multiples. They weren't as extended as they were in 2000. A lot of people say it's going to be like exactly like 2000 again. I don't think it's going to be like 2000. I think it's definitely already is and can to be worse than 2018. But not as bad as 2000 or the 70s is sort of my read. And I think like tech broadly, including crypto, it's definitely gotten way oversold relative to other stuff. Everyone seems to be kind of piling into the energy trade right now. If you did that a year ago, like Buffett did, it's very, very smart. Doing it now, I don't know. It doesn't feel like it has, super convex upside. It's kind of become a consensus trade. But to your point, I'm also not confident that we've bottomed yet. But I think it really depends on the liquidations thing. Like there's about 20 billion in open interest in futures and perpetuals and stuff right now. And the question mark is like, where are those people's liquidation prices, right? Like if their leverage is such that their liquidation price is like 10K, like I don't think we get there. If it's like, 17,400 or something, maybe we do, and that causes a cascade, and then we have a bottom, and then it kind of bounces back fairly quick, and then it's kind of slow, kind of like range bound, kind of grindy period over the next year or two. I could see that happening, but it's just hard to know like where the liquidation price is. That'd be great if that was able to if we knew that, but we don't, and so I think that's the kind of defines the question of like do we have this cascade or not? And I don't know.
I agree. I mean, look, within the next 2 years, there's going to be another halving in Bitcoin. I mean, to just stay where we are for the next 2 years, I guess that's rather unlikely. I mean, if any of the historical, fact patterns that we've seen around halvings and these type of things have any meaning, then it should start to move. So let's see. I guess we're here to watch it, to observe it, to comment on it. Joey, thank you so much for coming on. That was real fun. I enjoyed that. Thank you for your perspective on the market and all the background info you gave us. I hope we can do this another time.
Yeah, me too. Thanks for having me on. I really enjoyed the conversation.
Great. Thank you, Joey.
Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.